Namaskara. Welcome to another episode on marginal costing. And in this marginal costing module, you're going to understand as far as various calculations pertaining to the PV ratio and break-even point. And if at all any kind of questions are given with respect to uh, given amount of sales, how to calculate profit, and given amount of profit, how to calculate sales. All these calculations can be calculated in this question, in this module. So let us understand what is the question is given with respect to this company is concerned, where the details are given for two different years, that is 14 and 15. Number of units sold is given, say 2,700 units were sold for the year 2014 and 3,000 units were sold in the year 2015 at the rate of 100 and 100 rupees respectively. In both the years the selling price remains the same as 100 rupees, and the profit was given as 6,000 and 15,000 rupees. This is the only information is given that is pertaining to the sales and profit. If sales and profit is given, how to calculate PV ratio, how to calculate fixed cost, break-even point, sales to earn a profit of 10,000, and what is the profit at sales of 5 lakh rupees. In the previous module, we have solved the problems on the information which is given pertaining to the sales, variable cost, fixed cost, all this information. And there is another way where how to calculate the PV ratio and PV ratio and break-even point, and further calculation if only profit and sales is given. See, by analyzing the given information, where the sales is given as 2,700 units are sold at the rate of 100 rupees, that amounts to 2,70,000 rupees, and in the year 2015 the sales is given as 3,000 units were sold at the rate of 100 rupees. So with the given information, where we need to understand that whether the sales position is increased or decreased. The sales position during the last year was 2,70,000 and the current year is 3 lakh rupees. Therefore, there is a difference of 30,000. That difference is positive, that is to say increase in sales. Increase in sales to the tune of 30,000, and in case of a profit also, there is an increase of 9,000 rupees, 6,000 to 15,000. So that comes to 9,000 rupees. So with the help of this information, let us calculate the PV ratio and break-even point. The first and foremost, you need to calculate PV ratio. PV ratio can be calculated as where the difference in sales is we have identified as 30,000 rupees and difference in profit is identified as 9,000 rupees. If the values which have been identified based upon the difference, based upon the changes, or based upon the increase, then the formula for calculation of PV ratio is difference in profit divided by difference in sales into 100. So the difference in profit you have identified as 9,000. Difference in sales, that is the changes in sales, is called 30,000. So 9 over 30,000 into 100, you'll get a PV ratio as 30%. So this is another formula for calculation of PV ratio. Once the PV ratio is calculated, then we need to calculate fixed cost and variable cost. Because we are not aware of the fixed cost. Unless having the fixed cost, we cannot calculate the break-even point, because break-even point equals to fixed cost divided by PV ratio. In order to know or in order to calculate the fixed cost, prepare one simple marginal cost statement for two different years, where you have to get the same amount of fixed cost. Whatever the fixed cost for the year 2014, the same amount of fixed cost, we need to prove that. For that, the statement is sales minus variable cost is called contribution. Contribution minus fixed cost is called profit. First, fill up the details what is given. Sales for two different years are given, that is 2,70,000, and profit for two different years are given. So sales for the year 2014 is 2,70,000, the sales for the year 2015 is 3 lakhs. Similarly, profit is given for the 14 is 6,000 and profit for the year 2015 is 50,000. This is the thing, this is the only information which is given in the question. Based on this, we have calculated the PV ratio. PV ratio can also be called as contribution ratio, that is called 30%. Therefore, contribution is 30% on sales. That's what the meaning of the PV ratio. PV ratio is the ratio between the contribution and sales. That means the contribution is 30% on sales. 30% for the year 2014, 30% on 2,70,000 comes to 81,000. So 2,70,000 into 30%, that comes to 81,000. Similarly, calculate for the year 2015, that comes to 90,000. So after calculating the contribution, then it's very easy to calculate variable cost and fixed cost. To calculate variable cost, sales minus contribution. Sales minus variable cost is contribution, or sales minus contribution is also variable cost. 2,70,000 minus 81, you will get 1,89,000. 3 lakhs minus 90,000, you will get 2,10,000. Similarly, you can calculate the fixed cost, where contribution minus fixed cost is profit, or contribution plus profit is called fixed cost. Therefore, 81,000 minus 6,000 comes to 75,000. Similarly, 90,000 minus 15,000, that comes to 75,000. Now we know the fixed cost, variable cost, contribution, everything. So with this, we further calculate the break-even point and so on. To calculate break-even point, the simple formula is fixed cost divided by PV ratio. You know the fixed cost, just now we have calculated as 75,000, and PV ratio already been calculated as 30%. So 75,000 divided by 30%, it is called 25,000, 2,50,000 rupees, the break-even sales. Next sub question is how to calculate the value of the sales to earn a profit of 10,000 rupees. This means I want a profit of 10,000 rupees. So what could be my targeted sales? So in order to calculate this sales, the formula being is sales equals to fixed cost plus required profit over PV ratio. So for an amount of 10,000 rupees desired profit or required profit, what would be your sales that is to be calculated? For this, you know the value of fixed cost, you know the value of PV ratio, and your estimated profit or required profit is 10,000. With the help of this, with the help of this, you can calculate the amount of sales. So sales equals to fixed cost is 75,000, and the profit in which you require is 10,000 divided by the PV ratio is 30%. Therefore, your sales would be 2,83,333. That means if you make a sales of 2,83,333, probably you will be deriving a profit of 10,000 rupees. This is what a simple calculation, the prediction, the analysis of the cost, volume, profit. That is to say, you need to sell around 2,83,333 worth of goods, so that you will get a profit of 1,000 rupees. And this can be calculated in a reverse way, where what is the amount of profit in which you may get if I make a sales of so and so 3 lakhs, 4 lakhs, 5 lakhs, 10 lakhs, something like that. So when sales equals to 2,83,000, your profit is 10,000. If sales equals to 5 lakhs, what would be your profit? Assume that I may be for targeting, maybe focusing in order to sell to the tune of 5 lakh rupees. What could be my estimated profit? To calculate that also, we have to use the same formula. You can use the same formula. There are other way also. Sales equals to fixed cost plus desired profit divided by PV ratio. That means your fixed cost is 75,000. Your required sales is required sales is not required sales. The estimated sales is 5 lakh rupees, and your desired profit, let us assume it is X, and your PV ratio is 30%. If that is the case, then how to calculate the value of profit? Just by substituting the value sales equals to fixed cost plus desired profit divided by PV ratio, we may arrive at sales value is given as 5 lakh rupees, that is to say estimated sales. Fixed cost is already, we know that it is 75,000. and amount of profit in which you need to calculate, let us assume X over PV ratio is 30%. On cross multiplication, 75,000 plus X equals to 5 lakhs into 30%. Is 5 lakhs into 30%, that comes to 1.5 lakhs. So 75,000 plus X equals to 5 lakhs into 30%. I have taken as 1,50,000. Therefore, X equals to 1,50,000 minus 75,000, that comes to 75,000. So this is called your profit when your sales is 5 lakhs. So if you sell 5 lakh worth of goods, you will get a profit of 75,000. This is another calculation. Next is margin of safety at a profit of 24,000. Margin of safety can be calculated with the help of two formulae. As one is actual sales minus break-even sales, and another one is profit over PV ratio. The second formula normally we use when the profit is given in case of a margin of safety. If margin of safety is calculated at a given profit, whatever the profit is given, under that circumstances normally we use this formula, or otherwise even if you use this formula even in case of marginal cost statement also, you'll get the same answer. So profit over PV ratio. Profit is 24,000 divided by 30%, you'll get 80,000 rupees is your margin of safety. So this is how we need to calculate various kind of calculations in case of a marginal costing, and hope so you have understood and the simple calculations in which we have used. And thanks for listening, and keep watching and keep learning